Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, September the 25th, recording this in the morning about 7:30 as always. Okay, I just want to start off with just looking at copper. I guess everyone saw the news yesterday that the huge Freeport McMoran mine in Indonesia, the Grasberg mine, which is one of the world's it's the second biggest mine in the world, so a significant producer of gold, but also copper. Basically, they had a terrible sort of accident. A few people have been killed. They have to shut down the mine. There's a lot of uncertainty as to when that mine will reopen. Some people talking about 2027. So the point is, overall, it's a hit to global production of copper and to a lesser extent also of gold. And if we actually just look here, let's just look at the surge in prices yesterday. This is from the London price, which went up. You can see the huge surge in copper. And also, if you look at the high grade, you can also see over in the US contract that also went up quite a lot. But what is actually sort of interesting is just to see the reaction of the different sort of companies. So if we go and look at the copper space, which I'll put up here, you can see that the CPER, which is the overall copper index, that went up. But if we go then to COPEX, which is the global miners, that did spike and came down. But then you see the huge difference in the individual companies. So if we look at Freeport McMoran, huge gap down. They were at $46, gap down to about 37. Pre-market now trading at about 37.67. So Freeport taking a pretty nasty hit on that one. On the other hand, some of their competitors, you look at Southern Copper, they're enjoying the problems of their rivals, and also if you just look at the overall base metals index up quite a lot as well. So overall, that's an interesting one. Just to, as I say, keep an eye out for copper, and to a lesser extent, that could also be a little bit supportive at the margin to gold, because as we know that gold is often found in conjunction with copper. And so, as I say, at the margin, that will be a little less physical gold mined over the next probably 18 months. Talking of gold, still very strong, just coming off the highs a little bit. But, if we throw this on the moving averages, for example, the exponential moving averages, you can see that it's well above even its 20, even probably a little bit frothy. So it would not surprise me at all if this comes back down. It would actually be pretty healthy and reasonable if it came back down to, let's say, 36.30, something like that, which would also maybe coincide approximately at that point with a 20-day EMA. So that could be a potential entry point, could be an interesting entry point for people wanting to add or to go long. Similar situation if we look at silver, in the sense that just a very strong market, but silver not showing any sideways consolidation here. And in fact, this key level, which goes back to about 2011, which I think I signaled yesterday, about $44, as we can all see on the chart, breaking out above that. So silver really, well, what can you say? Just sort of ripping much higher. And again, enjoying all the benefits of gold and just paying a little bit of catch up. So silver at this point, super, super strong. Gold looking good. Even copper getting a little bit of a breakout. So the precious metals doing well. And that could also be just part of this idea of, if the global economies are trying to reflate with a lot of deficit spending, a lot of fiscal stimulus, a complete lack of desire on the parts of governments to rein in their sort of fiscal largesse, that is causing hard assets to rally up. And we're seeing that one of those is commodities, and especially the precious and semi-precious metals. Okay, so what else we have today? Some pretty important things. We have a big data dump in the US. Let's just look at what the data is. You can see here there's a lot of data. So let's start with initial jobless claims. And if you remember last week, we got 231,000, and that actually caused a fairly hawkish reaction in, especially, let's say, the bond market. We saw the 10-year go down about a full point, in the hour or two after that. So the market is really keeping a pretty close eye on the initial jobless claims, just because of obviously that's what the Fed has said they're most concerned about. Powell has said they're most concerned about a potential sort of a spike in the unemployment rate, or like a weakening in the employment situation. So definitely any employment data, and this is a timely one, a weekly one. So let's keep a lookout on that. Expected to be 233,000, which is very, very good. That's very constructive for the market. Initial jobless claims are the 4-week average. That's the one we want to look at. It's a little less noisy, so 240,000. And then the other thing which a lot of people are talking about is continuing claims. And it's this idea which Powell again reiterated in Rhode Island at his speech on Tuesday, I believe it was, essentially saying that we're in a sort of an unusually static labor market in the sense that people are not being fired, but they're also not being hired. So the sense that, employers are a little bit concerned and really, uncertain about the future of the economy. So they're not taking on new workers, but they're also reluctant to let go workers. And so it's a very static economy. And what's a labor market? And what's interesting with the continuing claims is the idea that, people, if they do lose their job because of that lack of hiring, that's becoming more difficult to pick up a new job. And therefore, the length of people who are continuing to claim unemployment benefits is starting to lengthen. So be that as it is, so we're expecting 1.932 million, a little bit higher than last week. So let's keep an eye out on that. But at the same time, excuse me, we also get the first read for August numbers on all the durable goods. As always, you want to be looking at the core numbers. So, excluding transportation like large commercial aircraft, we don't really want to be considering that because that's a little bit noisy. But capital goods orders, non-defense excluding air, and the ship non-defense excluding air. So we want to be looking at those core numbers. We also get a bit of an update here on the GDP. So you see it's for the second quarter. So it's the third reading. So this is getting pretty old at this point. Second quarter. So it's for April, May, June. Nonetheless, what could be interesting is probably more like the PCE index, just to see if that's revised a little bit upwards. That would be an indication potentially of some of those tariffs flow through effects, pushing up in inflation a little bit. Just by the way, it looks as though here we're getting a bunch of headlines from Stephen Miran. As we know, he was just recently installed at the Fed, courtesy of Mr. Trump, super dovish, calling for 25 basis points cuts by the end of this year. What is he saying? No doubt, I think policy is 150, 200 basis points too restrictive. Okay, so it looks as though he's pretty much just reiterating what he's been saying recently about the fact that the Fed is too restrictive and really needs to cut. So talking about the Fed, let's, as always, just have a look and see where we're at. What is interesting, we do have a lot of Fed speakers today. So we have Goolsbee, Williams, we have Schmidt, Bowman, Logan, Barr, and Daly. So we have 7 Fed speakers today. And as we know, there's quite a dispersion of views on the FOMC from the super doves, people like Stephen Miran, all the way out to someone like Schmidt, who's, almost arguing for well, I don't want to say for a hike, but, definitely in this sort of the more hawkish camp. And we heard Beth Hammack yesterday also being very sort of hawkish. So there's definitely a range of views, and it will be interesting to see at the end of today how they all shake out. And again, just looking at the Fed, what we've got here is about 42 basis points priced in. So it's less than 2 cuts at this point. So it's repriced slightly hawkishly. And again, if you just look at the tick chart here, so each segment here represents a day. So we're looking at about the last 5 or 6 trading days, essentially after the FOMC. And what you can see is that, we are trading in a range. It's nothing crazy, but we were down at the most dovish pricing was about 46 basis points of cuts, so almost 2 full cuts. And as you can see here on the chart, it's just ticked up a little bit. We're at about 42.7, so let's call it about 43 basis points. So we're trading in, about sort of a 3 basis point range here, but going up towards, slightly less sort of dovish take on things. So I think the data this morning and also the combination of the Fed speak, that'll probably give us a bit of market direction, certainly for today and maybe even over the next few days, as to whether the Fed, maybe the market has been a little bit optimistic, thinking that the Fed is, absolutely a slam dunk, to use a basketball term. It's absolute certainty that the Fed will be cutting both in October, as you see here, and also in December. But you see still here for October, still got almost 23 basis points, so 90% chance of a cut. So still, fairly optimistic of 2 cuts. But if we go all the way out to, let's say, we get on this out to, actually, we'll put it on the futures one. If you go all the way out to, 2026, the end of 2026, the market actually is only pricing in 4.2 cuts. So, 1.6, 1.7 cuts for this year, and then just another couple over the course of next year. So not quite as dovish as it may seem on the surface, the market is still, looking at a trough rate here of around about, looks like the lowest here is 2.99. Let's call it 3%. So we're certainly not in the days of, having a lower rate of 50 basis points or 1%, something like that. It's still, the market is saying that the longer run sort of lower trough rate there is only 3. So that's still relatively high, all things considered. Okay, the other thing I just want to look at is let's have a look. We have the Swiss National Bank overnight. And so if we just look at the Swiss franc, let's bring up the Swiss franc versus the US dollar. They didn't do anything in the sense that it was a hold. Let me just bring that up. So we have Swiss franc here. So we have a hold here. And then they kept interest rates at 0. And why was that? It was because they signaled in the statement that they were still a little concerned with inflation. It came in, slightly above their forecast. I mean, it's still at the lower end of their range, but for the Swiss, very careful about their inflation. So a bit worried still about inflation. And also they signaled a reluctance, I mean, only if necessary, to go into negative. If you'll recall, the current rate is at 0. And so the Swiss National Bank basically saying that, they were prepared to go in negative, but the hurdle, there was a speech a couple of weeks ago by the governor Schlegel, essentially saying that the hurdles for negative interest rates were fairly high. And as I say, they also in the statement said that they were still willing, if necessary, to intervene in the FX market to either buy or sell Swiss francs. But there was no specific mention about the strength of the Swiss franc. And we know here, we see, for example, here against the US dollar, you see how much the Swiss franc has strengthened or the US dollar has weakened against the Swiss franc. And so they didn't explicitly push back for that. So it seems at the moment the Swiss National Bank, holding the ship steady, so to speak, and not necessarily intervening to sell francs to weaken this. Although having said that, the US dollar is having just a little bit of a push up. And again, this is, as I've put here, some of these measured moves basically have been reached. So this is a recent low. So there's no, let's not overread into this. This could just be a reactive bounce just as the US dollar consolidates. But talking about the US dollar, let's have a quick look. As I say, the data today will probably give a little bit of a directionality to the US dollar against most of the other currencies. If we look at the dollar index here, you can see that, similar to the Swiss franc, it did bounce off this low from the beginning of July low around about 96.3. Again, is this a strong, sort of bull run? Not really. It's at this point, it's too early to say that. We're just caressing here the 50-day moving average just above the 20 here. So, until it really breaks above all of these recent highs at about 98 point. Let's call it 99 essentially. This is nothing more than a reactive bounce. It's difficult to say that this is any kind of bull market or bull reaction or anything like that. I think it would have to clear those first. The next hurdle that would probably coincide more or less with the 100-day moving average, and then it would have to maintain that level for a little bit, and then of course the next thing is to get up to 100. So we're still quite a long way away from that. It's going to depend on the data, the Fed speak. And also, other bigger issues such as Fed independence and the amount of issuance. We're going to have to keep an eye on all of that. Other thing which is happening today, which could be interesting in terms of the market, is in France. Let's just have a look at the OATs, which is the French bonds. Now, we can see here, just from a price perspective, the French bonds getting down. It's now a quadruple top, and I signaled a couple of weeks ago that it bounced off this level, but here we are. As I thought, it's gone all the way back down there, and you can see here that after that little sort of bounce here, it's gone back down, and that's just because the old prime minister who was around in this period, Bayrou. His government received a vote of no confidence. The new gentleman is a certain Mr. Le Cornu. Now, what's interesting is that today he's revealing his first, what they call the budgetary guidelines. And that'll be interesting to see if, either the left-wing parties or the more conservative right-wing parties, showing an indication of voting with him and supporting that. That would be a positive for the French bonds. But if it looks as though, there's immediate, sort of pushback from the opposition parties and that Le Cornu's budgetary guidelines are going to be rejected, who knows if maybe the OATs, the French 10-year, can actually break that level. And if it breaks this level at around about 120.80, I mean, if we just go back here, at this point, you start to get into some fairly dramatic territory. If you have a look here, just to put this in a historical perspective, this is quite an important moment. We're on the edge of the cliff. And if we start looking at some of the spreads, so if we look at the French spread here, you can see that it's pushed all the way up to some of these, I don't want to say crisis levels, but this is the original problem all the way going back to August of 2024 when Macron, called the elections and there was all the political upheaval in France, which sort of, essentially kicked off the crisis. And what we're seeing here is that the spread of the French bond over the German 10-year, it's now up to, what is it, 83 basis points. So it's sort of fiddled around a little bit, but it's now moving above all its moving averages and about to make this triple top and to break. You see, this is an important level here at about the 82, 83 basis points. And I would say that if there's a fairly negative reaction to Le Cornu's budget plans today, the market might start to worry a little bit more. Anticipating further political drama and basically the inability of the French to get their fiscal house in order. So continuing spending, a complete lack of desire, political will or appetite to rein in and reduce spending. And we could actually see just from a technical perspective, that looks like a fairly attractive target up here at 87 basis points. So, the way to play that could be just outright shorting the French bonds. But obviously, a much better way would be shorting the French bonds in a spread with long the German bunds as a spread trade there. So that's definitely something interesting to be looking out for today. Just while we're here, let's keep an eye on the Italian situation. And as you can see here, the spread of the Italian bonds over the German, if anything, we're basically at zero. Sorry, over French. So that's over the French one as zero. So the Italian bonds have come all the way now down to parity. I mean, historical perspective, we're talking the Italian bonds have sort of, historically the last, 10 years, 15 years, traded at a great premium in terms of yield. Look at this, up to even 2% over the French, but kind of a big day down to zero. And again, if we look at the Italian over the German, that's doing very well as well. And pretty close now, well, actually, as we just saw, exactly the same as the French. So trading very fairly attractive levels there. In terms of other things, we do have another bond auction today. We have the 7-year. The 2 and the 5-year auctions went reasonably well so far this week. So there's no reason to think that the 7-year can't go particularly well. But the bonds have been selling off. There's been quite a lot of concession. There was also a lot of long-term corporate issuance yesterday, a lot of investment grade issuance. If I remember, there was 15 billion, I think, from Oracle with some long duration tranches as well. So that's way down in the market. We see the 10-year here trading fairly heavily, and we also see the ZB, the 30-year trading fairly heavily. That's obviously not just a factor of long end investment grade issuance, which we got a lot yesterday, but also the fact that with people like Stephen Miran and clearly the Trump administration pushing hard, as we all know, to make the Fed more dovish, and the long end bond market is very concerned that means the Fed will drop the ball, so to speak, lose their focus on combating inflation, which of course will not be appreciated by the long end of the curve. Excuse me, just having some tea. Okay, so I might leave it there, guys. Just having a quick look here at the equities, just to finish off. You see equities coming off, zero technical damage done at this point. Uh, we're getting back towards the 20-day moving average. But listen, the equities have been rising and rising for many, many months, as we know. If we look here at Nasdaq, similar kind of situation. We look at the Russell. That has a slightly more aggressive sort of rejection candle here, like a doji for the Japanese candlestick. So that is definitely a little bit negative here. So let's keep an eye on all of this. Just looking here at the equal weight, also just hovering around the top here, pretty flat. And if we look at the Mag 7, just having a little bit of red. So it's early. It's too early to call this some kind of reversal. It could just be a bit of a sideways consolidation. And if the data comes in reasonably well today, that could be a positive thing as well. Okay, I'll leave it there today. Sorry, guys, no camera today. And we'll get back into this tomorrow and have a wonderful trading day. Thanks very much.